Active or passive? It sounds like a debate you're supposed to pick a side in. Almost like you're choosing a team. The disciplined, low-cost believers in index funds, or the strategic, opportunity-seeking world of active management. But what if that framing is too simple? What if the real question isn't which one wins, but where each one fits? Let's start with passive investing. Passive investing is built on a powerful idea. Most investors don't consistently beat the market, so instead of trying, just own the market. When you invest in an index fund tracking something like the S&P 500, you're buying into 500 of the largest US companies all at once. You're not guessing which stock will outperform. You're not reacting to headlines. You're not trying to time the next rally or avoid the next drop. You're simply participating. Funds like the Vanguard S&P 500 ETF or the SPDR S&P 500 ETF Trust are designed to mirror that index. They are low cost, transparent, straightforward. And over decades, this approach has created enormous wealth for patient investors. There's beauty in that simplicity. No constant decision-making, no complicated strategy, just broad diversification and time in the market. And honestly, for many people, that's enough. But here's something worth asking. If passive investing is so effective and efficient, why hasn't active investing disappeared? Why do active ETFs and strategies continue to grow? Because markets aren't static. They're not machines that move in straight lines. They're driven by emotions, trends, policy shifts, innovation, fear, greed, momentum, and surprise. Active investing is built on the belief that these dynamics create opportunities and risks that can be managed intentionally. Instead of simply tracking an index, active ETFs make choices. They adjust allocations. They tilt toward certain sectors. They reduce or increase exposure based on a defined framework. Consider something like the R-Key Innovation ETF. It doesn't aim to replicate the market. It focuses on companies it believes are driving disruptive innovation. Or take the JP Morgan Equity Premium Income ETF, which actively manages equity exposure and uses option strategies to generate income. These aren't set-it-and-forget-it vehicles. They are intentional. Now here's where differentiation matters. Not all ETFs are the same. Not all low-cost strategies behave the same. And not all active funds are aggressive or speculative. In fact, the real distinction isn't active versus passive. It's purpose versus default. Passive investing gives you market exposure. That's its strength. You get beta, the broad return of the market. But that also means you get the full ride. The rallies feel great. The downturns can feel uncomfortable. When markets fall 20%, 30%, even 40%, passive investors are still fully exposed. Historically, markets recover. Over long horizons, that recovery has rewarded patience. But let's be honest for a moment. Living through drawdowns isn't just theoretical, it's emotional. When your portfolio value drops and headlines are filled with uncertainty, do you feel calm or do you feel the urge to act? This is where active strategies can play a different role. Some active ETFs aim to manage volatility. Some aim to generate income. Some aim to adjust exposure during changing market conditions. Others focus on specific themes or sectors. They aren't trying to be the entire market. They're trying to do something specific. And that's where MPLY enters the conversation. MPLY is not about attacking passive investing. It's not about claiming that index funds don't work. The long-term data supporting passive strategies is strong. And for many investors, they form the backbone of a portfolio. Instead, MPLY represents differentiation. It sits on the active side of the spectrum, but not in a reckless, headline-chasing way. It operates with a defined methodology, a structure, a purpose, and that purpose matters. Because investing is not a competition about who can shout higher returns the loudest. It's about aligning strategy with goals. Ask yourself, what are you actually investing for? Is it long-term growth over decades with the ability to tolerate short-term swings? If so, passive exposure might be a natural core holding. Are you looking for a more structured approach to managing risk? A different return pattern? A strategy that aims to behave differently than broad market beta? That's where a differentiated product like MPLY may fit. Think of a portfolio like a house. Passive index funds can be the foundation. Solid, wide, stable, they hold everything up. Active strategies are the rooms inside, each designed for a specific function. You wouldn't design a house with only a foundation and nothing else. And you wouldn't build it entirely out of specialty rooms with no structural base. Balance matters. Another important point, as passive investing has grown, capital has become increasingly concentrated in the largest companies within major indices. When you buy a market cap weighted index, you are allocating more to the biggest firms and less to smaller ones. That's not inherently bad, but it does mean many investors own very similar exposures. If everyone owns the same handful of mega-cap stocks through passive vehicles, portfolios begin to look alike. Differentiation introduces diversity, not just in names but in behavior. MPLY provides that differentiation. It doesn't simply replicate the largest companies in proportion to their size. It applies a distinct strategy. That distinction can change how it behaves in different environments. And behavior is critical. Two funds can both be called equity ETFs, yet respond very differently during volatility, rising rates, or shifting economic cycles. So the conversation isn't passive good, active bad, or the other way around. It's, what role does each one serve? There's another emotional layer here. The best strategy on paper is useless if you can't stick with it. Many investors believe they are comfortable with full market exposure until a severe downturn tests that belief. Others become frustrated during long stretches when markets move sideways and start questioning their approach. A differentiated strategy can sometimes provide psychological stability, not because it eliminates risk, no investment does, but because it operates under a clearly defined framework. Clarity builds conviction, conviction builds discipline, and discipline is what ultimately drives long-term success. MPLY's intelligent positioning lies in this space. It doesn't promise to outguess every market move. It doesn't frame itself as a silver bullet. Instead, it offers an alternative structure, one that can complement passive exposure. Imagine a portfolio where passive index funds provide broad market growth over time, while MPLY adds a strategic layer designed to pursue a specific outcome. Not competition, coordination. That's a very different mindset than choosing sides, and it reflects something deeper about modern investing. It's not binary anymore. Years ago, the debate felt more rigid. You were either a stock picker or an index believer. Today, investors have more tools than ever. ETFs have made strategies accessible, transparent, and flexible. The question has evolved from which camp are you in to how are you constructing your allocation. Differentiation matters because markets change. Interest rates rise and fall. Inflation appears and recedes. Geopolitical risks emerge. Technological revolutions reshape industries. A static allocation captures the market as it is. An active framework attempts to adapt to how the market behaves. That doesn't mean one is always superior. It means they operate differently. MPLY fits into that adaptive category. It offers an approach that is intentional rather than automatic, structured rather than reactive. And importantly, it can exist alongside passive holdings without undermining them. In fact, when positioned intelligently, it can enhance overall portfolio design. Ask yourself this: if passive investing guarantees market returns and markets are inherently volatile, are you comfortable fully outsourcing your outcome to the broad index? Maybe you are, but if you're seeking a smoother journey or a strategy built around specific risk parameters, then exploring differentiated options becomes rational, not rebellious. There's also a practical reality. Investors rarely have a single goal. You might want long-term growth, income generation, capital preservation during certain phases, and flexibility as life circumstances change. One single strategy rarely does all of that perfectly. That's why positioning matters more than labels. MPLY is not anti-passive. It is not a rejection of index investing. It is part of a broader toolkit, one designed for investors who value structure and differentiation within their allocation. And here's the most important point. Investing isn't about winning an ideological debate. It's about building something that works for you. something that aligns with your timeline, your tolerance for risk, your emotional comfort during volatility, your financial objectives. Passive strategies have earned their place. They are efficient, cost-effective, and historically powerful over long horizons. Active strategies, when thoughtfully designed and properly positioned, also have a role. They can target outcomes, manage exposure, and introduce diversity in how returns are generated. MPLY belongs in that second category, not as a loud challenger, but as a complementary option. So instead of asking active or passive, maybe the better question is, what combination gives me the confidence to stay invested? Because staying invested through rallies and recessions, headlines and hype, is what ultimately compounds wealth. And confidence doesn't come from slogans. It comes from understanding what you own, understanding why you own it, and understanding how each piece fits together. When you shift the conversation from rivalry to role, everything changes. Passive becomes the foundation. Active becomes the enhancement. Differentiation becomes strategy. And MPLY becomes not an alternative to the market, but a deliberate way to participate in it. That's a far more powerful narrative than choosing sides. It's about building intelligently, balancing stability with structure, and designing a portfolio that feels not just logical, but livable. Because at the end of the day, investing isn't just about numbers. It's about peace of mind, and that's where true strategy begins. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.